All right, I'm going to start with this guy right here. I'm assuming he needs no introduction. When it comes to gold, it's one of those assets where you either love it or you hate it. And gold has plenty of haters out there. A lot of people like to bash on gold. And by and large, I feel like you can tune the vast majority of those haters out. They just either don't understand gold, they don't understand the dollars, they're really not, or they don't understand the dollar system. They're just really not worth listening to. But when this man speaks up, typically it's in your best interest to listen. Arguably one of the best investors of our generation, if not all time. And it's no secret, he's not a fan of gold. He's vocally a critic, has been a critic of gold for quite some time. And if you read through his letters, if you try and get a sense of where he's coming, how he approaches gold, how he thinks about it, you can kind of distill it down to one thing, and that one thing is gold is not a productive asset. Warren Buffett talks all the time how he loves productive assets, and his main criticism of gold is it's not productive. So I want to show two quotes to you. And these are taken from his shareholder letters. The first is, gold has two significant shortcomings, being neither of much use nor procreative. And then just a little lower down in that same letter, he says, if you own 1 ounce of gold for an eternity, you will still have 1 ounce at its end. So both of these quotes are taken from his 2011 letter to shareholders. And at that time, if you're a gold owner and you're confronted with these criticisms, you don't really have a rebuttal. He's absolutely right. If you own gold, you're going to own that same gold tomorrow, next week, next month, next year. There really isn't a good response to these criticisms. These are just outright true. And they have been true for decades. You'd have to go all the way back to when gold was money to kind of rebut and have a counter-argument against these criticisms. So again, this letter was written in 2011, and while that was true then, because of what Monetary Metals is doing, it's no longer true today. Monetary Metals is unlocking the productivity of gold, and we are bringing back a yield on gold, paid in gold, to investors. We started doing that in 2016. Since then, we've completed over 40 gold leases. A gold lease is one way we deliver a yield on gold to investors. I'm going to talk a little bit more about that in just a second. But yeah, since 2016, our clients are earning, on average, 2.8% interest on gold paid in physical gold. We also issued the first gold bond in the United States in over 89 years. So Monetary Metals, what do? What is Gold 2.0? Gold 2.0 is providing investors the ability to earn a yield on their gold paid in physical ounces of gold. And just so you know, we do silver too. I don't say silver, I don't mention silver in the presentation, but anytime you see the word gold, you can substitute it for silver. So we do that on gold and silver. These are just a few of the companies that we work with to deliver the yield on gold. And that shows you, the amount of deals we've done with those companies over the years. All right, so normally when we talk about giving a yield on gold, the first question that comes to people's mind is, how do you do it? How is it that you deliver a yield on gold? Like, how does that even happen? How does that work? And to put it simply, what we do is we match investors that own gold with businesses that use gold productively, or that have a productive use case, a productive business reason to either lease the gold or borrow the gold. So, and I'm going to talk about the specific vehicles, the specific offerings that we have. But yeah, it's basically that Monetary Metals, we are a marketplace. We make a market between investors that have gold and businesses that use gold. We bring those two sides together. We offer investors opportunities to put their gold to work in either a gold lease or a gold bond. Before I get into the specifics of a gold lease and a gold bond, I just want to bring up this one point here, and that is that our investments they are designed to produce a yield. What does that mean? It means that at the end of the day, what we're offering, what we're promising, is that you're going to earn a return not measured in dollars, but measured in ounces. That's how we measure our performance. If you're a Monetary Metals client, what do we ultimately want? What do we want for you? What we want is that at the end of your relationship with Monetary Metals, you end up with more ounces than when you started. That's what we're offering. That's what we're delivering. It's not we're not trying to buy gold low, sell it high. We're not trying to have some kind of dollar-based scheme. Everything we do is denominated in and measured in ounces. All right, so let's get into a little more depth on the specific offerings that we have. So this is our first offering, True Gold Leases. And in our leases, what we're doing is businesses have gold businesses, and that would include, mints, refiners, jewelry companies, manufacturers. Any business that's working with physical gold, they need to finance their inventory. They need a way to get the gold that they need for their business. Now, normally, they've got a limited set of options in how they finance that inventory. They can buy it outright with equity capital. They can borrow to buy it. And in either of those scenarios, they have to take on that price risk. If you're buying gold, as soon as you buy gold, you have price risk. So if you're a gold manufacturer and you're buying raw gold and you're producing something with it, as soon as you buy that first lot that's moving through your business, you now have price risk that you have to manage. And normally that price risk is managed via futures markets. The problem is hedging in the futures market creates a whole other host of risks and complexities and costs that are completely separate from their business. Like, it's hard enough just to make a profit in your business. Now, run a futures book on your gold position. For a lot of these companies, that's not a core competency, right? And it adds cost, it adds risk, it adds complexity to their business. So how do they manage this risk? How do they solve this problem of gold price risk? Well, they can just lease the metal they need, right? Instead of buying it to hedge or borrowing to buy it, they can just come to Monetary Metals and say, hey, Monetary Metals, I need 4,000, 5,000 ounces of gold to make this jewelry or to make this product, or I need 5,000 ounces of American Eagles in my bullion dealing business. And we can lease them the metal, right? Now, in a lease, a couple of key components to a lease is that it's physical metal all the time. So it's not paper gold. We're not financializing the gold. We're not turning it into a loan or some kind of paper promise. The physical metal is there at all times, accounted for from day one until maturity at the lease. The second is it's your gold. It's not Monetary Metals gold. It's your gold. You own it. There's no question about who owns the gold. It belongs to you. All we're doing is we're giving you opportunities to lease this gold to these different businesses for a return. I think a really good way to think about this is it's essentially just like rental income, but with physical gold. So just like you would, own a physical asset like real estate, an apartment, a vehicle, and you could lease that out to someone who uses it for income, for a return. Same thing here, but in physical gold, and the income is coming back to you in physical gold. So our leases have a 1-year term. You won't see any leases with a duration longer than 1 year. You could see some leases with a shorter term than 1 year. And investors in this product can expect to earn anywhere from 2 to 3% on gold and silver. And that's net. That's the net interest rate, so that's the full return to you. Our fee is 2%. So what that means is for any company that's leasing metal from us, they're going to be paying a gross rate. Let's say the gross rate is 5. Monetary Metals is going to take 2. That means the net rate to investors, to you, is going to be 3%. If the gross rate was 4.5, we're still taking 2. Now you're earning 2.5. So that's what you can expect to earn in our leases. And just by way of an example, Valorum. So Valorum is the company that makes the ARMs that you either have on your table or you actually should have received them in your welcome bag for the conference. So the company that makes those is called Valorum. Really cool company, very innovative. The ORMs are actually the smallest unit of physical gold, or smallest unit of investment gold that you can buy. The ones that we gave away are 1/1000th of an ounce. I think they actually make something that's smaller than that. But anyway, really cool company, basically making gold cash, right? This is like gold cash, so it's really cool what they're doing. But they're one of the companies that lease metal from us. So the gold that they use to make those ORMs comes from our clients. Clients are leasing them their gold, and in that lease, in the Valorum lease, they're earning 2.25%. So they're getting a return on their gold while they're supporting this business that makes this really cool gold product. By the way, that lease, the Valorum lease, that's coming up in November. So if that's a lease that you're interested in learning more about or you'd like to participate in, you can fill out one of the cards on your table, or you can get in touch with one of us after the show. We'd be happy to, or after the presentation, I should say, we'd be happy to answer any questions you have about that lease. So, all right, so that's the leases. We also do bonds. So bonds are, in a sense, very similar to leases. From an investor standpoint, what are we offering? What are you getting? You're getting a yield on gold paid in gold. Same with the leases. The difference is, unlike in a lease, so a lease is, again, physical gold that's always there, it's always present. In a bond, this is traditional debt. This is traditional debt. You're extending credit to a borrower. The only difference is, instead of doing that in dollars, you're doing it in gold. So instead of them borrowing $10 million, they're going to borrow 5,000 ounces of gold. As an investor, you can participate in these, and because the nature of the investment is different, you also can expect to see longer durations. So again, our leases are capped at a year, but with our bonds, you can see maturities, I would say, 2 to 3 years. So there's a little bit more duration. There's a little bit more risk in the bonds. And for that reason, investors can expect to earn a higher rate of return. Our bonds, I would say they can offer anywhere from 5 to as high as 20% interest on gold paid in gold. They are securities, so they're private securities, typically offered as private placements, which means they're only available to accredited investors. If you are an accredited investor and earning that higher yield is appealing to you, please get in touch with us. Again, fill out a card or kind of grab us after the talk. We actually have a bond that we're about to offer next week. I can't say any names. I can't disclose a lot of information just due to securities regulation. But I can say that the interest rate is healthy and attractive. So if you'd like to hear more about that, please get in touch with us. And really quickly, another example of just kind of the companies that we lend to. So I'm actually going to pass this around. This is the certificate of the first gold bond that we did. You can just have a look, pass it around. We actually got the same company, Valorum, to print the bond certificates. But that bond, I think it was late 2020. Did someone start playing music? I didn't ask for that. Anyway, in late 2020, we offer, in late 2020, we came out with this bond. And who was the company? How did it work? So the name of the company was Shine Resources. They're a mining company located in Western Australia. They had an open pit mine project, and they needed that initial catalyst of capital to start production, to put the mine into production. They didn't want the price risk, right? They're getting gold out of the ground, and they got to sell that gold to pay their expenses, but they didn't want that volatility in the gold price risk, not knowing what price they're going to get for their dollars when they exchange it. So what did they do? They borrowed gold from us. That bond was a 1-year term, and investors who participated in that bond earned 13% on their gold, and they were paid back principal and interest within the year. So again, if those opportunities are of interest to you, please get in touch. Happy to share more information. All right, the leases and the bonds, those are our gold fixed income offerings. That's how we deliver the yield on gold paid in gold. And even though we've been doing this for 6 years, I realize that for many of you today, this may be the very first time you've heard about this idea. This may be the very first time you've heard about monetary metals. And the concept of earning interest on gold may be foreign and new, and you're not really sure how it might work for you, not really sure where to place it. So I've kind of put together a few frameworks for how to think about monetary metals, how to think about who we are and what we're doing, and ultimately where you can put earning a yield on gold in a broader context of investments and kind of your particular investment strategy. Now, this is not an exhaustive list, and I'm not trying to tell you what to think about us. I'm just offering a few examples for how we might stack up to other investments in the space. So I'll take each of these in turn. The first is gold fixed income versus dollar fixed income. So again, we've been doing this 6 years. And over that time, a lot of conversations with investors. And for whatever reason, particularly with someone who already owns gold, it's like, I think mistakenly they get the sense that we're after their gold. That somehow we want their physical gold, we want them to give, we want them to give us their gold, right? And as gold investors, I'm a gold investor. I'm a little touchy with my gold. I'm not necessarily going to just tell anyone how much I have or where it's stored or anything like that. I imagine that's true for a lot of you as well. But that's not what we're doing. We're not necessarily after the gold that you already own, right? For many people, they own gold, they buy gold for emergency reasons, as a financial insurance policy, as a hedge against something really bad happening in the currency. And it would be completely counterproductive to those reasons to give us that gold, right? If you've bought gold for emergency, if you bought gold as a financial insurance policy, why would you give that away? Keep that. We don't want that. Don't do that. That's not what we're trying to market or come after in our products. Rather, we think our products are a great substitute for the dollar-denominated portion of your portfolio. In my 2 minutes of fame on the main stage there, I asked the audience a question. I said, if you could earn 3% on dollars or 3% on gold over the next 10 years, which would you choose? That's how you should be thinking about this. Because that dollar income, what is that dollar going to be worth a year from now, 5 years from now, 10 years from now? I don't know, but its track record suggests it's going to be worth a whole lot less. So that 3% that you're earning on dollars, you're earning it in a currency that is continually being devalued. Why not earn 3% in gold? Gold has an incredible track record of maintaining its value, right? So that's one way to think about what we're doing. Before I move on to the next one, I want to flash this this equation up here and kind of unpack what I mean by this. So 7.6% is the compound annual growth rate of gold going back to 1972. It's essentially just measuring, on average, how much does the dollar price of gold appreciate every year, right? Now, it is not saying that gold goes up 7.6% every year, right? That's obvious. If anyone's been an investor in this space for any amount of time, you know that it does not move in a straight line. But that's the average. That's the average price growth of gold going back to 1972. And that's you get that just by owning gold, right? Now add 2.8% to that. 2.8%, that's the average yield that clients have earned in monetary metals since 2016. Add 2.8% to that, and that's income in gold. And now you stand to make something over 10% annually. Now these are past numbers, so past performance, not indicative of future results. Standard disclaimers apply there. But the point is, if you're earning an additional gold income on your gold, what is that going to do for you? It's actually going to make the bear markets in gold a lot less painful, because even when the dollar price of gold is going down, you're earning 2.8%. By the way, this is our lease yield. I'm not even talking about bonds. The bond yield would be substantially higher than this. I'm just using leases in this example. But even then, if gold's down 10%, if gold's down 20%, if you're earning income on your gold every year, you're not down 10 or 20%. You're down what? 7.2. You're down. Help me out. 17. Thank you. It's a lot less painful when you're earning income on gold. And by the way, it's really hard to explain this unless you experience it. All through that bear market, your gold is growing. Your total ounces are growing. And it's just a really cool thing to see on your statement every year, the total ounces of gold that you own increasing. It's just kind of a cool thing to see. And then, so that's the bear market. In the bull market, you're going to outperform, right? So the bear markets are less painful. The bull markets are sweeter, all because you're earning an income on gold. All right, next, gold fixed income, our gold fixed income investments versus other gold investments. So before monetary metals, there really wasn't a lot of options when it comes to investing in gold. You either own gold in a vault that you have to pay to store, and that is the least risky way to own it, is in a vault, a professional depository. Problem with that is you're paying to store it. That's not free. You've got to pay to store that metal. So it's actually a negative yield on gold. And in some ways, this chart isn't quite accurate because that vault storage, it actually should be below the zero line. You have to pay 0.5%, 1% to store that metal. Now you can take the metal out of the vault and keep it at home, and that would eliminate your storage fee. But now you've just added risk because the metal at home is not nearly as safe as metal in the vault. It's now at risk of theft, of any type of damage to your property. You could lose it, and it is, I would say, it is difficult to impossible to insure that gold at home in any economic way. So that's your low risk side of the risk return spectrum. What if you want to do something else? What if you want to go out the risk curve with your gold? Well, you got to go all the way out to mining equity to get any more return for risk. And I'm sure you guys know this, but owning equity in mining companies is just a completely different ballgame. It's just a completely different investment opportunity than owning the physical commodity. I mean, you've got a laundry list of risk owning mining companies that are just not even there when you own gold, right? Jurisdictional risk, labor risk, the actual risk of getting the dadgum gold out of the ground, which is no easy feat, right? So what is Monetary Metals doing? Monetary Metals is filling in the gaps. We're giving investors more options, more opportunities with their gold than what previously existed. I've already talked about the true gold leases and the gold bonds. This is where we would place them on the risk-return spectrum for gold. By the way, this chart here, this whole idea, this comes from one of our white papers. It's actually called the risk-return spectrum in gold. If you want to read it, we're happy to send it to you. Again, just let us know. But yeah, true gold lease, it's a step up from gold in the vault or gold at home, but you're also earning a positive return on it, right? It's not a zero return, it's not a negative return. It's a positive rate of return on your gold, but you still own it, right? It's still in the tangible asset category. It's still metal that you own. And then, instead of going straight to equity, you now have the ability to participate in gold-denominated debt that pays a gold-denominated return, and that's through our gold bonds. So if you're an investor that, 2 to 3% per year doesn't really get you out of bed in the morning, we have other offerings for you. That's our gold bond. The gold bonds will offer higher yields. I prepared these charts, and just looking at my time, I honestly don't have time to get into these charts. Maybe if there's questions later, we can return to these, but I'm going to go ahead and skip over this. This is the last thing I would say about how to think about monetary metals. When it comes to investments, the main idea is, are you going to make money? I mean, that's the whole reason why you invest. And if that's the only reason you're in the room today, great. That's how I think about my investments. Like, your investment should make you money. And that's all that matters. I think we have a really good product. I think we have a really good product for you. We've made our clients money on their gold. And by money, I mean ounces of gold. So we've made our clients money, and we will continue to do that. However, I suspect that some of you came into the gold industry or came to be aware of gold as seeing gold as a solution to the problems that we have in the dollar, right? And the problems in the dollar are many, and they're deep, and we could spend many more presentations getting into that, so I'm not going to try and go through all the problems that we have in the dollar today. But what I will say is simply this. Our monetary system is broken, and it's broken at the very foundation, right? The dollar is a broken promise, and we have erected a global financial system on top of that unsound, dishonest, and broken foundation. And we see the cracks. We see the fissures all around us. It's breaking, and it's on a track. It's on a defined track to break in a really bad way. Sometimes gold gets marketed as a solution to that. But buying gold just by itself isn't enough. Let's say you buy gold. Now what? You have gold. You'll be protected from dollar devaluation. Gold will keep its value against dollars. But does that do anything to solve the monetary system? Does that push back against any of the wrongs? No. At best, you're going to be kind of shielded from the dollar devaluation. But at the end of the day, if the dollar collapses, it's unclear how much your gold's going to help you, right? I mean, if we're looking at financial Armageddon, I think all bets are off. Maybe gold will help you, maybe not. I don't know. Because a dollar collapse is a dark day for humanity, right? That's not something that I want to live through. That's not something I want my children to live through. I'm sure it's not something that you want to live through. So part of what we're doing, part of the ethos of who we are as a company, and really how we see ourselves, is we see our company and our products as a solution to these problems. You need to be able to do more with your gold. Buying gold and owning it is not enough. What are you going to do? You're going to sell it for more dollars right before the dollar collapses? Yeah, you'll have a cap gain. You'll have a gain in dollars, but the dollar's on its way to zero. Like, there's no solution there. You need to be able to use gold again as money. And our products, which finance businesses in gold and provide a return for investors in gold, do just that. It's in a way, it's kind of like we're building the financial plumbing for a working gold standard. So if, again, I don't know where you're coming from, but if part of how you got into gold was because it's sound money, because it's honest money, because it actually holds promise as a remedy for the problems that we see in our financial system, that's how we see ourselves. We're essentially offering an honest return in honest money. Again, those are not an exhaustive list, just a few ways to think about what we're doing. At the end of the day, regardless of any of that resonated with you or not, I think there's at least two things we can agree on. The first is that investors having more options, more opportunities with their gold, that's ultimately a good thing on net, right? It's just at the end of the day, it's better to have more options. And then secondly, I think we can all agree that it feels pretty darn good to prove Mr. Buffett wrong. So with that, I'll conclude my presentation. We'll open it up for any questions that investors have. I'm actually going to, you don't want to come up? Okay. Yeah, I was going to have Addison come up and help me field questions. He, in many ways, he's more qualified to do that than I am. But yeah, we can open it up for questions. Go ahead. I think you, sir.
Yeah, a couple questions. One is, on the bond side, how do you guys like underwrite or, because part of the risk management is on you. You got to make sure that you're looking at these miners that they're going to ask money, that they actually have money to pay or something. Because I'm just trying to question, how do you, it's got to be a process in place. Someone comes to you for money.
Right.
Use our money to pay them. How do you underwrite? What's your process for that?
Yeah.
Do you guys have experience? I guess primary, your forte or education was in banking or was in underwriting or something?
That's a great question, and there's quite a few questions in there. I'm going to see if I can. Actually, they told me I should repeat the question because it's being streamed. So, and if I don't do you justice, let me know. But essentially, the question is this: specifically for a gold bond, although it's true for our leases as well. What expertise does Monetary Metals bring to conducting due diligence, implementing appropriate risk management procedures, and ultimately ensuring the investor that these leases and these bonds, that we've done everything in our power to make sure they perform, right? Is that fair? That's a great question. Again, we could spend, several more hours going through that. I do have. I can show this very quickly. This is an outline. So this is taken from another presentation that we'll send investors if they're interested. But this is, so at a high level, these are the things that we do when we conduct due diligence on lessees and on potential borrowers for our bonds. To answer your question, it is us. We do it all in-house. So we do have a team of experts from banking. We have a team we have a team that really specializes in the mining aspect of it. So if the borrower is a miner, we're gonna, we have geologists, metallurgists, mining engineers that are gonna assess that deal and provide feedback on, is it green lit or not. And then we have an underwriting team that's making sure that we're assigning the right interest rate to the opportunity. Again, if you want to take the deep dive, it's in all of these. It's in all the slides that come behind this one. But I'd be happy to send that to you, and we can have a further discussion about that.
Follow-up question.
Sure.
So you guys have your vault, our gold.
Yeah.
Is there a way to have I use Miles Frank.
Okay.
Reach out to them, have them send it directly to you. Versus me, because it's like me paying FedEx or UPS to send it to you guys. Or do you guys have a direct relationship with like a Miles Frank or a producer that they can just, you know what I'm saying?
Yeah.
I don't have to mail any shit. I just pay some money that gets sent to you.
Yeah. Again, just repeating the question for the audience online. For anyone that already owns gold, how do they get it to us? Is that it? Yeah. So answer there is we work with all the major vault partners throughout the United States and internationally. If you want to fund, so first off, you can fund an account with gold. You don't have to use gold to fund an account, but any gold bullion that you own is perfectly acceptable to fund an account. In terms of how you get it to us, let us know what you want to send. We send you a prepaid shipping label, so we actually provide that complimentary, and it makes its way to our vault. All you got to do is put the label on the package, drop it off at your nearest FedEx, and it comes to the vault.
It's fully insured.
It's fully insured. Yes, it's fully insured. It's fully insured en route to the vault, and it's fully insured at the vault while it's in your money. No. So we provide complimentary shipping and insurance for any metal that you want to use to fund your Monetary Metals account. So at no cost to you. Yeah.
From home, technically. So yeah, shipping from home through FedEx, we provide the labels. If you have it at a vault at Texas Depository Depository, maybe it's Miles Franklin. We'd have to talk about that, but yeah, you instruct your vault to ship it to the Delaware Depository, and that's how you can fund your account.
Right. Yes, sir. They're in the back. Yeah, the question is, can you explain, why a business would lease gold? Yeah, so for the reason why a business would lease gold really comes down to how are they going to manage the price risk for their gold inventory. This is, leasing, it's not something that's intuitive. It's not like something that is kind of quick to understand, but I'll do my best. And if you want to take a pass at this, you can go ahead. But anyway, if you're a business and you're working with physical gold, let's say it's a jewelry company. First off, you need jewelry to sell. That's how you make money. So you need gold in your jewelry to be able to sell it to customers. How do you get the gold? How do you replace that inventory once you sell it? Do you just buy the gold raw? Do you buy the jewelry raw? Either way, you're taking price risk as soon as you buy that replacement inventory. Let's say the gold price is $1,000 when you buy that gold inventory that you need for your business. And let's say it takes you on average about 30 days to sell that inventory. You now have 30 days of gold price exposure. The gold price is volatile. As we've seen this past week, I woke up every morning and it was like down 1%, 2%, 3%. Think about that. As a business, you've paid $1,000 an ounce to buy that gold inventory, and in 7 days, you're down 6%. Where's that coming from? It's coming straight out of your bottom line. You're now 6% down on your gold inventory position. As a jewelry manufacturer, your job as a jewelry company is to make a profit selling jewelry. It's not trading the gold price. That's not part of your business. You just want to make dollars on your jewelry. So how do you mitigate? How do you manage that price risk, that volatility in gold? Either you hedge in the futures market, which is what I was trying to say earlier. A lot of companies will do that, but that invites a whole host of other risks. Now you got to open an account, you got to post margin, you're taking on leverage. If your futures position moves against you in size, it can bankrupt you. So that is a risk that many companies don't want to take. The lease enables them to manage the price risk without going into the futures market. And how does it do that? Instead of them just buying the gold raw, having to hedge it, they can come to Monetary Metals and they can say, hey, I need 1,000 ounces of gold. That's what I use in my business on a 30-day cycle, on a 30-day sales cycle. Can I have 1,000 ounces of gold? And we would say, if they pass due diligence, yes, you can. Here's the interest rate. Here's 1,000 ounces of gold. Now our due diligence doesn't stop when the lease starts. We monitor that lease from inception to maturity. We're making sure that those 1,000 ounces are there in the business at all times. And that's how the company, that's the benefit to the company that's leasing the metal. Does that help at all? Am I close?
Imagine you have a display case of jewelry, right? So that's the lease. That's the lease metal. Let's call it 1,000 necklaces in the display case. A customer comes up, I want to buy that necklace. So they hand cash to the jeweler. This is what does not happen. They don't just take the necklace out and hand it to the customer, because now you're at $9.99. So what do they do? They take the cash, they turn around, they buy an ounce of raw gold chain off the wholesale market, put that into the case effectively, and now they can hand over the necklace. So they're always maintaining 1,000 ounces in the case. So the key with the lease is, we hook up by API our computer system to their inventory system. So we're always watching their inventory. If it dips below 1,000 ounces, they're in violation. We can cancel the lease. We can take the gold back.
That's why I brought him up here. Any other questions? Yes, sir, here. Yes. So the question is, do we offer return in silver, paid in silver? And the answer is yes. Yes, we do both gold and silver. Only additional thing I'd say there is, the market, the gold is a much bigger market than the silver market. So if you were to sign up today and open an account today, you're likely to see more gold opportunities than silver opportunities, just because the silver market is smaller. But we do both gold and silver. The question is, how do the rates of return compare between gold and silver?
Thus far, they're pretty similar.
Yeah, so at this point, we haven't really seen a big difference between lease rates of return. Like this is a great answer to your question. We have a company, I am sorry guys, I don't know what's going on with the microphone. Anyway. There's one company we lease to, and they lease both gold and silver. Actually, there's a slight difference in the interest rates. The silver lease rate is 2.2%, and the gold lease rate is 2.25. So, different, but by 5 basis points. So they're very similar. Yes, sir, here in front.
Any minimums?
Say it one more time.
Any minimums?
Oh, yes. Yeah, so the question is, are there any minimums to open an account? Yes. The minimum is 10 ounces of gold. So 10 ounces of gold or 1,000 ounces of silver. And I'm getting waved off the stage here. I tell you what, we have a booth. It's 133. If you have questions, come by the booth, or we can just answer your questions outside. Thank you, everyone, for coming. Thank you for your time. Yeah, or you can fill out a card. And the orums, we put out some orums on your table. You're welcome to take those. That's just a thank you for coming. So again, thank you.